I still think that market is very, very underowned. And while I originally never thought of much higher prices, people that know me, I was never one that spoke about 4,000 gold, 5,000 gold. But the things that are happening and what is going to be happening this fall when people start to see that the BRICS are not only a formidable, potentially mind-boggling challenge for the Western world, particularly the United States, but they're actually moving towards having a trading mechanism that's going to include gold. When that comes evident and people realize where all this gold purchasing has really been going for and why it's happening and why all these countries have been repatriating their gold from the United States, then and only then we're going to see the awesome amount of powers that be in the general investment community come to gold.
Sprott Asset Management says gold has outperformed major asset classes over the past 23 years, historically enhancing returns and increasing diversification. In the wake of rampant geopolitical tensions, economic uncertainties, lingering inflation, and a heavily anticipated U.S. election, gold has continued its status as the symbol of safety and reassurance. As the Chief Market Strategist at Peter Grandich Company, he has earned a reputation for his insightful market analysis, particularly in precious metals. Based on fundamentals, Peter Grandich observes that gold has exceeded investors' expectations, outperforming stocks and bonds over recent years. He envisions a market shift as BRICS nations adopt a gold-backed trading mechanism, which could attract new investors to gold. A move to de-dollarization is driving central banks' interest in gold, helping keep gold prices elevated. The central banks are improving the overall quality of their reserves. Ebkarian, co-founder of precious metals dealer Allegiance Gold, told Investors Business Daily. While re-evaluating silver, Grandich explains that although gold has historically outperformed, current conditions make a strong case for silver investment. He highlights improved supply-demand dynamics and rising industrial use, suggesting silver now deserves equal representation in a metals portfolio. Silver spot prices have outperformed gold in 2024, rising almost 40% in the first half of the year to test the all-time high of around $32.7 at the end of the second quarter. This rally was driven primarily by geopolitics risks, U.S. interest rate cut expectations, and a rise in global industrial demand for silver, which has reached a fresh record high this year, according to the Silver Institute's World Silver Survey. According to the report, the demand for silver massively exceeded supply globally last year, and in 2024, it is predicted to continue for a fourth year in a row. Now we present the clips of Peter Grandich's insights from his recent interview. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Just think about what you just said. First of all, it's been 2,400 maybe for a month or 3 months. And if I would have said to anybody 5 years ago when it was 1,600 and I was talking about 2536 by 2025, you know what I used to hear a lot? Nah, no way. Not going to happen. There's too many things against it. It's manipulated. It's this, it's that. I got to go back to what I just said a couple of minutes ago in our interview, and that is gold has outperformed stocks and bonds. It is the Rodney Dangerfield of all investments. It gets absolutely no respect. It's treated like kryptonite by the general investment community. Let me put it to you this way, and I'm not the originator of this. A man named Andy Schectman has driven it home and driven it home correctly. There's only three tier one investment products in the world: stocks, bonds, and gold. Everything else is rated below that. You go to any portfolio anywhere in the United States in any type of financial service industry, I'll find stocks, I'll find bonds. I'll need a microscope to find people that own physical gold. And yet they're considered and should be kind of split among that and all. So I still think that market is very, very underowned. And while I originally never thought of much higher prices, people that know me, I was never one that spoke about 4,000 gold, 5,000 gold. But the things that are happening and what is going to be happening this fall when people start to see that the BRICS are not only a formidable, potentially mind-boggling challenge for the Western world, particularly the United States, but they're actually moving towards having a trading mechanism that's going to include gold. When that comes evident and people realize where all this gold purchasing has really been going for and why it's happening and why all these countries have been repatriating their gold from the United States, then and only then we're going to see the awesome amount of powers that be in the general investment community come to gold. And that's going to be the challenge for us that were buying it at 12 or 1300. We're going to need to sell them some at that point in time. So I'm not a gold bug that's all I believe in, and I've only had it. There were times when I was against it, and I learned that gold bugs don't like you when you go from being bullish to bearish. But I really think it's very underrepresented and not getting its due for the performance it's had and what's at stake coming forward. I really, really think people have, I'll say this, and I've said it publicly. I believe when we look back, when the hindsight Monday morning quarterback's being done, people will look back and go, wow, Wall Street really blew it. They never recognized what the BRICS formation was and what it was going to lead to. I've said it before and I'll say it again. I think when it's all said and done, which is probably 3 to 5 years from now, what they will have done to world trade will be the same impact that the Industrial Revolution had on world trade. And the United States is going to be outside looking in. 25 years when I spoke at all the mining conferences and all, I used to get the silver bugs mad at me at the conference because I always say owning silver is like kissing your sister because gold would always outperform it. And it has. It has right up till today. It's been a better performer and all. But I think the argument for silver is a lot better now. I think it's the best argument it's ever had. It clearly has a much better supply demand scenario. It has a much more increase in industrial use. And the public, as they shift more to the metals themselves, the public at large tends to like silver in individuals versus massive pension people and so forth. But it's always going to almost in a sense be right behind gold. It's never, there may be times and for a short period of time it'll trade that way, but I think it has the best bullish argument and needs to basically almost have equal representation now in a metals portfolio when that was not my view for decades.
Despite the gains in physical gold, Peter Grandich points out that those invested in mining shares have experienced losses. He observes that major mining stocks are reaching new highs, and that rising trading volumes in junior stocks suggest growing investor interest in hard assets. The gold miners' stocks are enjoying a strong summer, recently surging to new bull highs. These up-leg gains should continue mounting with gold's autumn rally providing stiff tailwinds. Since gold's demand-driven seasonality fuels gold stocks' seasonality, that's logically the best place to start to understand what's likely coming. This old research thread focuses on modern bull market seasonality, as bull and bear price actions differ. Gold enjoyed an epic 638.2% bull run from April 2001 to August 2011, fueling gold stocks skyrocketing 1,664.4% per their leading HUI index then. Concurrently, Grandich suggests that while gold has outperformed other assets since 2000, many who focus on hard assets are misguided in hoping for a market crash. He predicts that sudden crashes are less likely due to current safeguards, but a gradual decline over time is still possible. Let's get back to the interview.
Most of the people who talk about why wasn't there a crash and all are not the people that are actively involved in the general stock market. They're in the people that are in the hard asset things who've been betting on the hard assets because they felt this crash would lead them that the only thing that will work is the hard assets. And if you look at that, gold did that. Gold has outperformed since January 1st, 2000. Gold has outperformed both stocks and bonds. But there are also people like me that probably played mining shares and digressed even further to junior resource stocks. And there, we've not seen the performance that we were hoping for. And therefore, oh, if they only crashed. The last thing anybody here that's interested in hard assets should root for is a stock market crash. Because the crash will not allow a rollover or expectation to move elsewhere. It'll just be people panicking to survive. So I never been in a crash camp or want to see a kind of a crash thing. But I do think, and I go back to again, take that top of the pyramid away. Most people have gone sideways to down for years now, and it's becoming harder and harder to do. And eventually, interest rates don't have to be dramatically higher. They just have to be higher than what people are earning. And that's what people have not spoken about from the Don't Worry, Be Happy crowd. The lack of earning power for the average American has dwindled. And therefore, they may not recognize it, but their purchasing power, they realize it when they go shopping. You know, anybody that buys food can tell you inflation's more than 0.3%. the amount that it's increased to buy the typical basket that we were just buying 5 or 10 years ago has doubled. Talk to anybody that owns, we have a lot of clients that own restaurants. They'll tell you their cost of food is doubled or tripled. So the inflation number that's put out and all the things that come out from governments deal with the reality. We all know how much costly it's going to be. So stock market crashes, yeah, first of all, I think we had a crash in 87 because we didn't have mechanisms to kind of slow down a market when everybody's running to the door to get out. So I don't know if we're ever going to have a crash where we're down 20, 30% in a day because quite frankly, the mechanics are there to kind of slow that down. Can we end up down 20, 30, 50% over several years? That's possible. But I'm not in the camp of, a market crash anytime. Most of those people that were concerned about the gold price not moving as much and all, they probably own mining shares and junior resource stocks that
Mm.
have people that I know that just own physical bullion, some pension people I dealt with and all, they're real happy in what gold done. But if you had mining shares and junior resource stocks like me and see seven-figure losses and you see gold going up and you own gold stocks and they're going down, yeah, why gold should go up more because the main reason we want it to go up more is finally, hopefully, it's going to lift our stock. But I think that's changed too. And I don't want to jump over whatever you wanted to speak to me about. But I think that's another bullish indicator. The major mining companies now stocks are doing very well. In fact, many are
Mm.
going to 52-week highs. And that suggests to me that we are seeing some of that money shift from the paper asset players, the stock and bond market, to some of the hard assets. And of course, it'll take probably a little bit more, but we're even starting to see volume come into the junior stocks. And volume always precedes price. So since that market has been in a very poor performance for years, but now at least we're seeing a lot of these stocks trading 5 to 10 times more their average trading volume. It's telling you buyers are showing up again. They're just not ready to chase the market.
Sprott Asset Management's senior portfolio manager John Hathaway believes the yellow metal hitting $3,000 per ounce within a year isn't far-fetched, and highlighted the potential for a 15% to 20% gold price rise to have an outsized impact on mining stocks. How do you anticipate the evolving geopolitical landscape will influence your investment strategy in gold and silver? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.